I'm Jay Rod here with the man of the hour, Zach Scheit, to cut through the noise. Also, it's great to see you. We were both in Bretton Woods, New Hampshire last week for a critical meeting with Jim Rickards, our good colleague. But yeah, it was great to see you, man. And
yeah, no kidding. We'll start out with the easy one. That was so much fun. Just getting together with our team and Bretton Woods. What a historical place where the gold standard, the International Monetary Fund, where so many important things in finance happened, and to be able to kind of sit down in those hallowed grounds with Jim Rickards, Byron, Dan Amos, many of the great minds that we get to work with on a day-to-day basis. Every time all of us get together, we get to hash over ideas and what's going on in the market and get different perspectives. And all of those perspectives really help each one of us, I think, kind of sharpen our skills, have a more accurate picture of what's going on. And so I'm excited. I feel just honored and blessed to be able to be with so many great minds. And we covered a lot of great ground. So you guys will be seeing plenty of information that comes out of Bretton Woods over the next few weeks for sure. The other thing that I wanted to mention to you today is that earnings, we're actually wrapping up earnings season. The official or the unofficial, however you want to call it, end of earnings season is typically when Walmart reports earnings, and that happened this week. So as we look back on the earnings reports, they're not great, but they're not nearly as bad as investors were expecting. So a lot of people who were looking at the overall economy thought that that earnings were going to be very bad, and that was going to be kind of the next catalyst to move stocks lower. Since that didn't happen, we've seen a pretty good bear market rally. Now, one of the best areas of strength that we've seen this earnings season is the travel and entertainment area. And I've written about this quite a bit, but affluent customers, they've been locked up for 2 years. They want to get out. So even though the market's lower, even though there's a lot of uncertainty out there, these travelers are getting out there and they're buying airline tickets, they're buying hotel rooms, they're paying for car rentals, and all of that is helping to drive travel related stocks higher. We're also starting to see business travel, just like us heading to Bretton Woods. Business travel is picking back up. Teams are getting back together, and we're starting to kind of see that, yes, we do in fact need to spend time together. This is kind of accentuated by the big news from Apple this week, where Apple said, we want our workers to be back in the office. Maybe it's 2 days a week, maybe it's 3 days a week, but we want to get our people together. As companies kind of start to feel the freedom of saying, yes, we want to get people back together, that's going to drive up business travel, partly because they're just going to get their normal teams back together. But it goes hand in hand to say, if we want our teams together, we also want our salespeople to be out visiting customers. We want our customer service groups to go out and actually be on site with those customers and make sure that we're taking good care of them. So we're going to see a lot more travel pick up, and that can help your airline stocks, hotel stocks, and even leisure stocks like Six Flags and SeaWorld, which is Busch Gardens. As families continue to take vacations and look for holiday plans and so forth, we're going to see more and more travel and some strength in those stocks, I think. A big question that we've got right now after earnings season, now that we've kind of gotten a chance to work through all of those reports, is what's going on in the market? Is this a bear market rally, or is this the start of a new bull market? And sometimes that drives me nuts because the truth is we don't really need to slap a label on this and say, all right, today it's a bull market, yesterday it was a bear market. We need to continue to look at actually what's happening on the ground and not get swayed by those individual labels. I say that because just last week, the NASDAQ composite ran up 20% from the low that it had earlier this year. And according to the technical definition, just like the recession, what is a technical definition of recession or a bull market or a bear market? Technically, the NASDAQ is now in a bull market because it's up 20%. Does that mean, sound the all clear sign and let's jump in? And no, not at all. We still, as we said, we've still got a lot of volatility. We've still got a lot of challenges for the market, and we could trade back down and test the lows. I think that's definitely a possibility. But this jump for the NASDAQ does create some interesting opportunities. So the speculative froth, or the animal spirits, whatever you want to call it, has come back. speculative investors are back in the market, driving stock prices higher, and it's affecting other areas of the market too. So I do think if you're an active trader, this is a chance to set up a really quite a few really profitable short positions. And a short position is simply when you bet that stocks are going to trade back down. Some of you know how to buy put contracts, which means that you're betting that the stock will trade lower, and these put contracts increase in value if stocks trade lower. I think this is a good time to start putting together a shopping list of speculative tech stocks that don't make money or don't make much money, and that are trading at just unreasonable valuations and have moved higher. Those are areas that you can make a lot of money if they come back down if you buy put contracts. If you're going to sell short some of these speculative tech stocks, don't do it right away. Wait until you start to see some weakness in the market, until you start to see these stocks trading lower, because otherwise they could continue higher. If a price doesn't make sense at the price that it's at right now because it's too high, if it doesn't make sense and it's already decoupled or pulled away from what reality is, there's no reason that it can't continue to move higher, because continuing to move higher doesn't make sense. We've already established this stock doesn't make sense. So you have to wait for reality to actually come back in before you step in and make a major bearish trade on those stocks. So it's something to think about. Make sure that you understand what risk you're taking. Don't bet the farm on anything trading lower or higher. But it's an area that we could create some good wealth just by betting against these stocks that just don't belong at this high price. Another way to think about it is if you're still in some of these really speculative tech stocks, the cloud computing stocks, the streaming stocks that are not making money, Bed Bath & Beyond, now is a great time to get out. Count it a gift. If these stocks trade higher and they don't deserve to trade higher, count it a gift, sell your shares, and let's move capital into some of these companies that actually make money, that actually generate profits and can create value for you over the long term. I do think that the 2020s, this decade, will be looked back at as the decade where investors moved away from concepts and excitement and ideas and back into really good fundamentals and looking at investments from a way that makes sense in terms of how much money is this company generating and what is a reasonable price for me to pay compared to those earnings. As we move back into that area, I'm excited because it means that we can actually make reliable profits in your account. We can generate reliable income by buying stocks that pay a generous dividend. And those areas will help you sleep at night because they're not going to be nearly as volatile as these speculative tech stocks. So I guess that's my takeaway as we wrap up today's call. Let's make sure that we're thinking fundamentally about the best stocks that actually, the companies that make reliable profits, companies that pay generous dividends, companies that can survive, all of this economic turmoil back and forth. Those are the names that you want to be invested in. And those are going to protect and grow your wealth for years to come. And hopefully you can teach your loved ones, that your children, your grandchildren, how this works so that you can actually create wealth for generations to come, which really makes me excited. So J-Rod, that's what I've got prepared for today, where we're at in the market. Would love to hear your thoughts. And I know we got to wrap up quick, but yeah, that's what I've got.
I think, again, as always, did a fabulous job of cutting through the what is actually the Inflation Reduction Act, and offered up some really good plays to to capitalize on both falling dollar and the ridiculousness that has come back to the markets, which we both know that the Federal Reserve is not going to stand by and say, okay, this is okay. The idiots that are running up these stocks that are, companies that are more or less not even close to their valuation. That's only going to be fuel to the fire for them to, continue on their course.
That's a good point, because it does increase inflation in financial markets, which gives them more cover to continue to increase interest rates. That's a really good point.
Right. But yeah, some really good stuff here. And again, you talked earlier about the NASDAQ, that rally. Mm-hmm. Bear market rallies have taken out quite a few of the sharpest minds in the market by.
That is true for sure. And you've done a lot of studies on bear market rallies. How many put you on the spot here, but how many 20% rebounds did we have during I think it was during either the dot-com crisis or maybe it was after the financial crisis, but I do remember there were several rebounds like this that then
Right.
rolled over and made new lows afterwards.
Yeah, there were, if I'm not mistaken, there were 20% plus bear rallies in the 2000, and then in 2008 there were two.
Okay, gotcha.
Two bear.
So just because we rebounded by 20% doesn't mean it's all good. We can relax now.
No, and in the 2000s bear market, the drops after those rallies were even worse than the initial drop. So, if you're caught unaware, you could take even more of a beating than you did the first time. So yeah, I mean,
and to add a little context to that, at the same time, during that dot-com crash that we had, even though the NASDAQ rallied like that and then continued to make new lows, during that whole period, dividend stocks and value stocks actually held their ground quite well. So investors that were making kind of those same smart decisions that we're talking about right now were not hit by the dot-com crash. In fact, if you were invested in good dividend stocks and value stocks, you might not have even realized there was a bear market because your stocks were holding up just fine.
Hanging out at cruising altitude, as a good pilot might add.
40,000 feet, just smooth sailing.
Well, that's great. And again, fantastic call. We've got a lot of really great content, and thank you so much. Again, it was so great to see you last week at Bretton Woods. We're fueling the economy by taking a trip out there, but yeah, it was great times
for sure.
Well, yeah, and on behalf of it's all we have for today, but as always, we'll do this again in a month. I'm J Rod, and we'll see you in a month.
See you in a month, guys. Thanks for being on the call.